All right, today we're cracking open the books on First REIT's 2025 financials. Now, this is known as Asia's top healthcare trust, but if you're an investor, you probably noticed one key number that, well, it didn't look so good this year. We're going to find out exactly why. So let's dive right in.
So first things first, what exactly is First REIT? You hear the term Asia's premier healthcare trust, and it sounds pretty impressive, right? But what does that actually mean when it comes to your money?
At its heart, it's a collection of properties, think hospitals and nursing homes spread across Indonesia, Singapore, and Japan. The whole idea behind investing in it is pretty simple. Healthcare is generally a stable, defensive sector. So it should, in theory, provide a steady, reliable income stream for its investors, who we call unit holders.
And that, of course, brings us to the million-dollar question. For all the investors who bought into that promise of stability, did the trust actually come through in 2025?
Okay, for anyone who invests in a REIT, or a real estate investment trust, there's really only one number that truly matters above all else: the distribution per unit, or DPU. You can forget all the other noise. This is the actual cash that gets deposited into your account.
And here's the headline number. The distribution per unit for 2025. It was down 8.1% compared to the year before. Now, for an investment that's specifically designed for income, a drop like this immediately makes you sit up and ask, why? Why did this happen? And that's exactly what we're going to answer.
Let's look at the raw numbers here. The DPU fell from 2.36 cents down to 2.17 cents. And the reason for that is pretty clear. The total pile of cash that's available to be paid out, what they call the distributable amount, it actually shrank by more than 7%, from 49.3 million down to 45.8 million Singapore dollars.
So, to figure out why less cash was paid out, we've got to follow the money. We need to trace its journey right from the top of the income statement all the way down to that final distribution.
This right here shows you the perfect storm, a real cascade effect. It's fascinating, actually. See how a small leak at the very top becomes a huge flood at the bottom? It all started with just a tiny 1.6% dip in rental income. But by the time that little drop trickled down through all the expenses, it just snowballed into a huge 7.1% drop in the cash pool, which ultimately led to that painful 8.1% hit to investor payouts.
So, we've done it. We've traced the problem all the way back to its source, that initial 1.6% drop in rental income. And now, the next question is pretty obvious. What caused that?
The answer really boils down to two words: currency headwinds. See, because First REIT owns properties in a few different countries, but reports all of its earnings in Singapore dollars, it's totally exposed to the ups and downs of foreign exchange rates.
And we don't even have to guess. The company tells us exactly why. The drop was, and I quote, mainly due to weakening of Indonesia rupiah and Japanese yen. This is the key insight. Even if the hospitals in Indonesia and Japan were doing great and making lots of money in their local currencies, that money was simply worth less when they had to convert it back into Singapore dollars for their financial reports. Here's a really simple way to think about it. Imagine you're working overseas, right? And you're earning your salary in, say, euros. If the euros suddenly gets weaker compared to your home currency, your paycheck is literally worth less when you bring it home to pay your bills. That is exactly what happened to First REIT with the rent money it was collecting from Indonesia and Japan.
Okay, so that explains the what happened. But as an investor, you're probably more interested in what's going to happen next. And, the story isn't all doom and gloom. The company has some real strengths, but it's also facing some pretty major risks.
And this slide really captures the tightrope that First REIT is walking right now. On the one hand, you've got a huge positive. They've done an amazing job controlling costs. I mean, slashing your operating expenses by over 15% in 1 year, that's impressive, and it creates a nice buffer. But on the other side, the big risks are the very same problems they just ran into: that persistent currency weakness and a global economy that's looking a bit shaky. So let's just quickly recap everything we've covered. The big takeaway is that investor payouts were down, and down significantly. We followed the breadcrumbs back to lower rental income, which, as we saw, was really caused by those unfavorable currency exchange rates. Now, the silver lining was some seriously good cost management, but looking forward, those same currency issues are still the #1 risk for investors to keep a very close eye on.
So this is really the final question for any investor watching First REIT. It's become a battle between what the company can control, which is its spending, and what it can't, which are these huge global currency markets. The big question is, will their impressive cost-cutting be enough to shield them from the economic storms that might be brewing? That's what we'll have to wait and see.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.